I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe. A busy week coming to a close. Sales topping 30 billion euros for a fifth consecutive week. Yankee debt sales dominating high-grade issuance in the US, accounting for 90% of the 15 million in sales this week. And junk bond issuers slowly emerging in the US this week as well. Jacob Land Rover coming to market, selling $500 million of 8-year notes. With us still, Subhadra Japa, Eric Nelson and Jim Bianco as well. Subhadra, let's start right here, because so many people are talking about this at the moment. They're not talking about the levels of growth. They're talking about the rate of change, the deceleration. We've seen peak rate of change, peak growth. Is that an important dynamic for this market at the moment for you, Subhadra?
It is. I mean, I think that, it's very early to state that we've reached peak growth. We still need to see some data in the upcoming weeks. But that's really a concern, is that we could see a potential slowdown in what's already penciled in. I mean, the Fed has 7% GDP penciled in for this year. Inflation is expected to top 2.5%. So we just have to see if the data actually delivers.
Well, let's get into the data. And I've been doing this through the week, and I'd love to do it with you guys too. 6.6% is the 2021 GDP figure. Eric, 4.1%, that is the consensus view for 22. 2.3% is the consensus view for 23. We've got a shift from 6 this year, 4, 22, then back to 2 in 23. Now, those three things are important. You can look at them and say, OK, rate of change matters, deceleration, or you can look at that and say cumulative change is the most important thing for this bond market. Take a listen to what Bob Michael of JP Morgan had to say on that very question.
Oh, for sure. It's the cumulative gains. It actually looks as though the output gap will close by the end of the year. So modern monetary theory has worked, and I think that's a very important consideration. With the output gap closing and the U.S. economy operating above its long-term potential, that does create a lot of inflationary pressure, and that does put the pressure on the Fed and its new flexible average inflation targeting regime.
Clearly took a little bit of time to find that, some technical issues, and I apologise for that. Eric Nelson, I'd love your reaction to the same question, please.
Well, John, to me, the cumulative change is what matters. And another way to look at that is just looking at the level of GDP. So when it's all said and done, our economists expect a level of GDP to be even above the pre-COVID trend by the end of next year. So that in itself is very important. And when we look at the level of real yields in the market right now, looking at the 10-year real yield back around minus 100 basis points, that to me is way out of line with this above-trend growth that we're seeing. So as we expect nominal yields to start to come back over the next few months, real yields are likely to be a big driver of that as the market starts to realize they've corrected too far in the other direction on real yields and growth expectations.
What do you think, Jim?
The one thing that we seem to be missing from this argument is whether or not there will be more stimulus. So far, we've had a lot of stimulus in 20 and 21. If that doesn't produce inflation, or that doesn't produce any kind of dislocation, I would expect that we will see more stimulus as we go into 22 and 23. Why wouldn't we? If all it does is produces a new high in the stock market, helps the unemployed, gives the poor something, and no consequence comes from it, we should expect more stimulus. And therefore, I think when you talk about the cumulative change, I agree with that the cumulative change of the economy is important, but we might still be understating what it could be unless we get some kind of inflation spurt to change thinking. We could see more stimulus coming down the pike later this year and into next year, and even higher growth rates than those 22 and 23 estimates.
Subhadra, your reaction?
Yeah, I mean, I think that the rate of change is definitely important. And I think the longer-term trajectory to me is much more important. We get 7% this year, we get another 4% next year, and then it's going to take a few years before we get down to around 2.5% in growth. And that is a very strong, robust trajectory. And then on top of that, we're going to get some more, perhaps, infrastructure spending that's also going to feed through over the next several years. So to me, all of that tells me that potential GDP is going to be a lot higher over the next several years.
The next layer of this, of course, is how the Fed responds to it. We had the Fed minutes out a little bit earlier this week. And Eric Nelson, I think you make the right point. just what is the reaction function of the Federal Reserve? Now, they've spent a year and a half telling us what it is, but the doubts have crept in. This is what they had to say in the recent minutes, and I think this quote here is really important. Although they generally saw the risk to the outlook for economic activity as broadly balanced, a substantial majority of participants judged that the risk to their inflation projections were tilted to the upside. Now, this goes back to something I said earlier. This is not a shift in the reaction function. It's not even a shift in the forecast. It's a shift in the balance of risks around their forecast. But Eric Nelson, apparently that's very important for this market right now.
Absolutely, John. And this is something where we were certainly a little bit surprised to not see the PCE forecast move up in those June projections, given the shift in the dots. But as we think about what the Fed is going to do next, we're talking about another few months where the Fed's going to have a really hard time putting its finger on the pulse of the American economy. It's probably not until September or October when they can really get a clean read on the labor market in particular. So to us, the tapering discussion probably won't happen really in kind until the fall, which means perhaps a December announcement and a Q1 initiation of the tapering process.
So I feel like Jackson holds the date in the diary every single year for some kind of Fed pivot. But given what you've just said, and most people agree with you, Eric, they come on this show, they come on other programs that I get to host with others, and they talk about September being key. It's when the additional unemployment insurance expires, when the kids go back to school, maybe we solve some childcare issues. So, Badger, with that in mind, if we don't really get a clean read on the labour market until fall, autumn, Q4 of this year, why would the Fed make a move before then or make any kind of declaration that they're about to make a move?
That is exactly the concern that the bond market is expressing in the last week, which is that they might not. The Fed has somewhat boxed itself into its substantial further progress, mantra, right? So they are going to have to wait to see the data before they act. If you ask me personally, I mean, given the amount of QE we've had over the last couple of years, what I would expect the Fed to have done by now is to start tapering asset purchases now. I mean, equities are at historical highs. Financial conditions are extraordinarily accommodative, and yields are very, very low. So this is, if anything, the perfect time for them to start stepping back from asset purchases. But they've told us that they're not going to do that, and that's really the concern that's driving the bond market, is that they're not going to be able to taper asset purchases because they won't be able to make substantial further progress on the employment front.
Subhadra Rajappa alongside Jim Bianco and Eric Nelson sticking with us. Still ahead, the final spread, the week ahead, featuring Chairman Jay Powell delivering another testimony on Capitol Hill. From New York, this is Bloomberg.